and the email goes out. And we just, like, our phones are blowing up.
Goes through the roof, and you're like, oh, we've made it. And then, of course, the next week, the traffic's back to zero.
They're actually buying a promise that we are there when it matters.
You are signing up for this obligation where, like, this becomes your life's work.
That was really painful. It was 3 years of litigation. And, right, was very unfocused, tried to build all the things. And so who wants to deal with insurance here? Yeah, that's what I thought.
Before we dive in, I do want to give a couple quick thanks. So obviously, James and Startup Grind, thank you so much for helping us put this on. Really fantastic program for entrepreneurs. Canopy, the shared co-working space, both here in Menlo Park and in San Francisco. They also are offering day passes, so stay tuned for info on that. And then we also have a fantastic wine sponsor. Hopefully many of you enjoyed it today. Wente Vineyards is, believe it or not, one of the oldest family-owned wineries in California. They are right nearby here in Livermore. And if you have ever had California Chardonnay, you have likely had the Wente clone of Chardonnay. That's how influential they are in the industry. So huge thank you to everyone. And without further ado, today I'm thrilled to welcome Travis Hedge, co-founder of Vouch Insurance. And so before launching Vouch, Travis was part of the investment team at SVB Capital. He worked closely with early stage founders and VCs there and learned firsthand all the pain points servicing early stage founders and helping them secure coverage. And Vouch is backed by top investors Ribbit Capital, Y Combinator, and Redpoint. So huge welcome, Travis.
Thanks for having me, Jeff. Thrilled to be here.
So I want to start out with a quick sort of overhyped, underrated. You started Vouch in downtown San Francisco. Would you do that again today?
Absolutely, but I don't know if I'll be here forever. Okay. And here's what, so I'm a little biased. You've had, I think this is your fifth show?
Yes.
40% of your guests now are from Columbus, Ohio. So I think there's a real concentration of talent there. I'm excited to get back to someday. We've got kids, family, the whole 9 yards. But no, I really believe that it's important for any founder to spend a lot of time here. I've gained so many relationships and I've learned so much from being here that I'm excited to take back to Columbus someday. And I'm really excited about markets like Columbus all over the world.
That's awesome. That's awesome. And as you're scaling Vouch, you do have other offices. Share a bit about that.
Yeah. So we actually, from day one, were really intentional about having a second office because we knew that we could not find the insurance talent we would need here in the Bay Area.
Yep.
And so we ran a whole analysis. Chicago was the obvious choice, great insurance talent, great talent overall. So we have a big office in Chicago, and then New York is our third main hub. And then about half our team is remote all over the country.
And how has that been, sort of hybrid in offices, remote?
Hard. Look, we were 30 people, had just launched a couple months prior to COVID happening. So had to really scale the team up in those times. And I think we've really valued in-person collaboration too. So we try to get the best of both worlds, but that's really hard. And so we try to be really intentional about making Vouch a great place for all of our employees. And in particular, really try to drive as much in-person collaboration as possible.
Awesome. Well, all right. So before I ask this question, keep in mind I've spent 6 years building accounting software. When people hear the word insurance, it sounds a little boring. How did you get into insurance?
Oh, boy. So over the holidays, my dad found a little book report I made in third grade, I guess career day report in third grade saying, I want to be an insurance agent.
Yes.
Actually. Now, that's because my dad was an insurance agent. But took a winding path to get here. Did a little bipartisan political startup in college, did the VC stuff. But I think the main thing I actually took away from my dad and what really made me tick was he grew up in Appalachia, dirt floors. Starting that insurance agency is what gave me every opportunity in life. And so I was really passionate about really paying that forward and entrepreneurship and what it can do for people. And so I knew I wanted to do that someday. I knew I wanted to help other entrepreneurs. That was actually part of the little spiel as to why I wanted to do it in third grade. And so it's been really cool for that to come full circle. And also just saw how broken insurance was firsthand, investing in it. And the companies we worked with at SVB, it was a real pain point for them.
And so I want to help everyone here understand. So for those unfamiliar with Vouch, with business insurance, let's imagine you're a founder. What should you be thinking about? How do you guys help them?
Yeah. So Well, I'll tell you what founders typically think about, then I'll tell you what they should be thinking about. When we first started, interviewed hundreds of founders, and the most glaring thing that stood out to us was 0% of first-time founders knew to get business insurance when they got started. 67%, so 2/3 of repeat founders knew to get it at company formation. And I think that's two reasons. One is, for better or worse, that repeat founder might have seen what can go wrong. You can get sued, you can get hacked, all the above. But they'd also gone through those stages of growth. So as a first-time founder, you sign a lease and general liability is required. An investor joins your board, directors and officers is required. Sign a big enterprise contract. You got to get your SOC 2 and your cyber insurance. And so most folks, the perspective is, hey, let's get this done as quickly as possible, check the box, spend as little as possible. But I can't tell you how often companies will come to us and they took that approach. They're maybe an accounting software services business, right? But you're not just a software company, right? You're helping people with their finances. And so getting that coverage right and making sure those real risks are protected is critically important. And so that's where having a real consultative relationship with your insurance partner is important.
And the insurance industry obviously is not a new thing. It's a very mature industry overall. What was the opportunity you saw? What was the pain point that you were like, I need to start a company?
Yeah, so the first thing was my dad's agency got hacked. Okay. The first few months I had moved here, 10, 11 years ago, that was really painful. It was 3 years of litigation, and ultimately his banking partner was responsible, and there was a real risk of his business not being around. And that was a visceral emotional experience, but it was also made me think a lot about how do you prevent bad things from happening in the first place, whether it's startup founders or small business owners. And I also was fortunate enough to invest in companies like Root Insurance and Ladder Life and others that were taking this kind of vertically integrated approach. And then the third thing was I was working with founders all day, and so I got to talk to them about it. And they would send me these 50-page PDFs for their cyber insurance over email. And it's okay, I think we can do something about this. But the big thing, so I'd worked at Nationwide Ventures prior to SVB Capital, and I saw how hard it was. You had smart people, but it was how hard it was to actually get things done. Mm-hmm. And that ultimately the companies that were building new risks, building new companies that were building the future weren't big enough for them to care about. And so there was a clear opportunity for us to go actually design not just a better digital experience, but actually better coverage itself to actually de-risk these businesses. And, this is my pie in the sky aspirational part of it, but I actually think we can help facilitate innovation by making it, allowing entrepreneurs to take real risks and not get derailed by dumb stuff.
This is such a perfect example of what I call founder market fit. Everyone talks about product market fit, but there's so much about who the founder is and their experience. You really lived and breathed this whole industry, and it sounds like knew sort of the ins and outs even before you started the company.
It does feel like my life's calling, and I feel incredibly grateful to get to do this every day. And I will say, early days, I was the insurance guy, and then a few months later, we hired a real insurance guy, and that, he showed me everything I didn't know.
Are there any lessons you took from your time at Nationwide or SVB that you've applied to Vouch?
Yeah, a lot from both. I think the biggest thing, in particular from my time at SVB, was when I was there, everyone really cared about the founders and the companies we were working with. Mm-hmm. And that was what made me tick every day. And I think, as any organization gets bigger, you get more caught up in the bureaucracy and the stuff that doesn't matter. And so definitely took that away from it in a lot of ways. And then the business model for Vouch itself, right? We could talk all day about SVB, but I think they were very explicitly focused on serving the innovation economy.
Yep.
And when I talk to a lot of investors, or especially when I talk to our insurance partners, it's but isn't that a really small market? And I'm please keep saying that, and we'll talk in 10 years.
I love it. And so, that is a great question. How did you initially define your ICP, your ideal customer profile? How did you pick startups? Are there any caveats to that? Who do you serve the best?
Yeah. That was a hard lesson for me to learn, because I remember my first startup in college. This was getting the buddies around the dorm. Hey, you guys want to do this? where I bit off way more than I can chew. All right, was very unfocused, tried to build all the things, and so coming into Vouch really tried to hone that in. And at first I was like, okay, well it's venture-backed startups, and then my head of product's like, no, let's get more focused. It is venture-backed technology companies that do not yet have an insurance policy.
Okay.
And that distinction is really important because the switching motion versus the first time motion, very different. And how you find those customers, very different. So I mentioned before, like first time founders, not motivated in and of themselves to go get it. So we could have chosen to go spend a bunch of time educating people on why.
Yep. Or
we could go partner with the people that are already there in those moments and be there waiting when they actually needed it. And so that's the distribution, approach we took.
And so what was your MVP? Take us back to like your initial launch. What was that? How did you decide it was ready to go to market?
Well, I laugh because I remember when Sam, my co-founder, and I got together, one of the first things we did was pick the launch date. So, and actually, we should talk about this because I think you guys took a very different approach.
Yes.
Where we said, look, in a complex business like this, we could spend forever building the MVP. And so we gave ourselves a really strict 1-year deadline to go ship something that people could buy. And that really forced us to reduce scope and focus, which maybe he just knew that I had my eyes were bigger than my stomach and he needed to, focus me.
Yep.
But no, I think a few different nuances about insurance. One, it's regulated state by state. So we had to figure out what state are we going to go live in first. Analyze the whole country, pick the state that had insurance regulations that allowed us to go live on a given specific date. If we had picked California first, we might still be waiting. And then looked at venture capital activity. And so Utah was like the Caitlin Clark on this chart of like the perfect place to go do it. And so I spent 6 months camped out in Utah, like going door to door at co-working spaces like this, meeting founders. And it was the ability to buy. We actually had 3 different policies you could buy. You could do it either on your phone or desktop within 10 minutes. And so I remember we did an event kind of like this to launch in Utah. And I was pretty stoked because I think our third customer, I was able to get him to do it entirely on his phone. And
Nice.
that was like, you couldn't buy this stuff same day, nonetheless on your phone. And so that was a pretty cool. Now, to be clear, the first 2 customers, day one, it was YC demo day. And so Sam is up on stage doing the YC demo day thing. I'm onboarding our first 2 customers, and we've got engineers in the background being like, everything's breaking. What is going on? But we figured it out, and that was, God, I could talk all day about that. That was a wild time.
I love it. No, launch stories are the best.
So, but you guys took a very different approach.
We have, yes.
So we're heads down for what, 5 years?
5 years. And so my first 2 companies, though, were not. We're all very quick, actually. The first 2, from founding to acquisition in both cases, was about 16 months. So incredibly crazy short stories. This one, we were very intentional of like, we need to go deep. And what I realized is when you're building accounting software, no one is going to trust a half-baked accounting software product, right? Like it either does the accounting or it doesn't. And so we've gone very, very deep and built all of the tech we need before launch, and we haven't even really done a public launch. We've been out in the market word of mouth, but we haven't made any big press noise about it. That'll come in a little bit. And so it was more of a like, this market is huge. We want to do this correctly. For this specific industry, you need to be super disciplined and like have all the I's dotted and T's crossed and so on. But I think it's very precise to what type of product you're building, what market you're targeting, et cetera.
Totally. And look, I think there's actually two things that are similar but different about our approach. So a couple things we have in common, like regulated, boring industries. We sell to startups, and we're taking something they already buy today and kind of have to buy and making it better.
Yep.
I think a little bit of what's different is, one, our product, like our actual product is the policy itself.
Right.
Not the software. And so we were able to take, okay, well, what is the product they're buying today? We innovated on that a little bit around the edges. V1 was maybe a 2 out of 10 on that scale. Over time, we were able to ratchet that up, right? But
Yep.
what we were able to spend a lot of our like 0 to 1 energy on was getting the software basics stood up. And good news for us was like the bar could not have been lower.
Right.
So yeah, I think versus you guys really had to you had to get it right.
Right. You don't track DAU, I imagine.
No.
Right. They sign up, they get the policy. You don't want them to be.
We actually have like an inverse DAU. It's like for our clients, like the less they talk to us, the better. Who wants to deal with insurance here? Yeah, that's what I thought.
Totally. So yeah, definitely strategize your launch based on the product and market.
Yeah.
So going back to your launch, so what was the first 3 customers' reaction? What did they think?
Well, the first 2 were probably like, why is this taking so long? Why are engineers like screaming in the background? No, they were great. They were a fellow YC batchmate was one. The other one was a company called TaxBit that went on, just funny, like they were our first customer. So the whole playbook, right, is be the first insurance policy, scale with these companies as they grow.
Yep.
And that just happened to be one of the like 1% companies that actually goes on to be really big, like pure luck. But their reaction was basically like, wow, despite this is so much better than what I've been doing today, especially the guy that bought on his phone. But despite that, insurance was not such a visceral pain point that like people are banging down the door saying, take my money, right?
Right.
So I think we were really proud of that initial reaction that we had, and it's certainly, we had a bunch of kinks to work out, don't get me wrong, but like, oh, okay, this works, people are buying it. I think the hard thing was, I still remember it was like week 3 or week 4, where we sold 0 policies. And like, I walked out of week 1 thinking, all right, we're gonna do 10 next week, like this thing's cooking. But there was all this momentum we had built up in the lead up, right?
Yep.
And then it became, oh, okay, well, we just burnt through that. Now we actually got to go do this thing.
Right.
And that was a little bit of a, you kind of know what your early team is made of in that moment. And I just remember some of our early folks, huddling together like, this isn't happening again. And that was pretty cool.
This is like the classic TechCrunch launch. I saw it at my first startup. You do all the work, you get the press, you get an article, your traffic goes through the roof, and you're like, oh, we've made it. And then, of course, the next week, the traffic's back to 0. And you're like, okay, now we need to do the real work to like...
So I got to tell you just like 2 quick funny stories on that. One, so we had our holiday party a few weeks later, and we had like worked out the kinks, and somehow, like honestly, months before we expected, got approval to go live in California.
Cool.
And that's a whole long story we could talk about someday. And so we got our partners at Silicon Valley Bank to send an email out to all 10,000 in-scope clients in California.
Wow.
And we had expected it to go out like the day before. And so we're now all like in the back of Ubers and Lyfts going to our holiday party, and the email goes out. And we just, like, our phones are blowing up. Like, so we end up spending our whole holiday party just, like, on laptops in the corner, like, answering chats. Yeah. And then COVID happened a few months later, and we're all looking around like, all right, what is going on? Pausing everything. And I think, to this day, I still think there was something about that moment where people realized, like, oh, this little tail risk thing can actually happen. And that ended up, we saw a big tailwind coming out of that. Who knows why? But that moment ended up being a big, everything took off from there.
So a classic startup challenge is you're a newcomer in a market. There's entrenched players. No one ever gets fired for choosing Microsoft, et cetera, right? Like, no one's going to complain if you like to say, oh, pick this big staid insurance company.
Yeah.
Did you get that skepticism? How did you deal with that, like, as a newcomer in the space?
We still get that to this day.
Okay.
All the time, especially you can imagine Series C, Series D rolls around. You bring in an experienced CFO. Their broker takes them golfing every month. Like, that we still come up against that. And it's like, why should I trust the new guys in town? Couple things. And look, the first barrier we had to overcome was getting regulators and reinsurers to agree to work with us. And so part of that was building out the right capital partners early on, and building the right balance sheet. The next part of it was bringing in the right experienced leadership. So I was by far the youngest, least experienced person on the leadership team. And so that credibility helped. And then but with customers, we just leaned into the, hey, we are for founders by founders, and I'm not gonna be able to sell everybody. And then hopefully we just build that credibility over time. Now today, that experienced CFO persona, we do try to overcome that we've been able to hire 10, 15, 20-year experienced brokers, and that's the person we are really selling for them to build trust in.
Yeah, that makes a ton of sense. All right, let's switch gears to fundraising. Always popular topic. I want to go back to the first round, back to the early days of Vouch. Tell us about how you approached that fundraise, what happened.
Yeah, so I guess technically my first pitch was I went to the partners at SVB Capital, the fund I was working for, and was like, hey, I really want to go do this. Think of it as like SVB for insurance, kind of. But at that time, well, like the Brexes and Mercuries weren't around yet, but it's like, hey, this is digital first, kind of challenger model. And the reaction was, hey, like, why don't you go find that company to invest in? And so part of that process, every investment memo includes this like strengths and risks section. And so I kind of wrote that out. Like, okay, if I were to go start this, what would be the strengths and what would be the risks? And I'm like, strengths, sweet idea. Risks, like everything else. There's a little more to it than that, but that's pretty much it. And like, I think the next 2 years, so that was 2016.
Okay.
I got to go every quarter back to Columbus for the Root Insurance board meeting with Nick Shalick from Ribbit Capital. And he and I kept talking about the need for this thing to exist. I got to invest in companies that were pursuing similar business models in different categories. All that said, I remember 2 years later, Nick called me, and we actually were just catching up. And we're like, hey, that thing still really needs to exist. Do you want to go do this together?
Wow.
And he introduced me to Sam, who he had backed in his last business. So my co-founder was the more experienced one that I've learned a lot from along the way. And we spent 6 weeks doing the co-founder dating thing. And so we were really lucky to have such an amazing partner like Ribbit really in our corner from day one. I think the takeaway from that is the whole lines not dots thing is very real.
Yep.
If I had gone and pitched Nick on this in 2016, it wouldn't have worked. But we built those lines kind of together. And then, I think from there, being able to get YC on board as another early investor, SVB on board as another early investor, all great. I was able to rely on my co-founder's credibility to help do that. And, I think it helped that, again, we were solving a problem that they were all very familiar with.
Yep.
Their teams all buy insurance too. And, the fact that we weren't trying to go drive new user behavior, they saw the vision. All those factors together. So the lines, not dots, the founder credibility, and I think just the storytelling and knowing your audience probably helped a little bit.
And what's been the trajectory since? Roughly how much have you raised across how many rounds?
Yeah, so that first round was about $25 million. Again, we needed the balance sheet to be credible with reinsurers and regulators. That was a big part of it. Took a lot of dilution along the way, but that's what you got to do. So then YC's Continuity Fund led our Series B, which was great. And then Redpoint came in and led our Series C, which was about a $90 million round in 2021. Cool. We've raised a little bit more capital since then, and hopefully have some more news to share soon.
Awesome. Well, a hot topic for the past few weeks, given Bench's sort of sudden collapse, has been venture debt. What is your take on venture debt, particularly having worked at SVB?
Yeah, so I was on the equity side of the house, so that was always a fun, we're collaborating with those folks. I think it really depends on your business and what you're using it for. So I was really active in these fintech business models where debt was a real tool in the balance sheet. So part of the reason we were able to get this next wave of insurtech businesses off the ground was actually really leaning in with them and saying, hey, debt is part of what fuels every insurance business. There's these things called surplus notes, but the legacy capital markets were not willing to do that for a new insurtech.
Yep.
And so we were able to come up with a really unique structure at SVB to solve that need in the market. I think your typical venture debt story, it can help extend your runway. It can give you that extra buffer up front. But I also think any kind of debt can be overused. I mean, dude, it's like any vice, right? Drugs, alcohol, you name it. Sure, a little bit is good.
Yep.
Don't be stupid.
Yep. As our last fundraising question, so as you raise these later rounds, you're building relationships with new investors. How are you doing the narrative storytelling? How are you bringing them along with your journey?
Yeah, now it is all about numbers, right?
Okay.
So we've raised $200 million total. At that point, you're a metrics business. It's not a story, but the numbers have to tell a story. So for instance, when we're talking to technology investors, they look at our retention metrics and stuff like that. They're like, yeah, that's good. When we talk to insurance investors, like, your retention metrics are insanely good. And so there's a little bit of that like storytelling you got to do to both sides. And then there's also just like the art of the possible. Like, what are you going to do from here? And there are so many different directions that you can take things. I think that's one of the biggest challenges is like, how do you tell the story internally of we got to really stay focused and execute, while externally painting that picture of like, yeah, over the next 5 years, we're going to go, conquer the world.
Right.
Yeah.
All right, I want to talk about leadership. So you've scaled this over 6 years, 6+ years now, to 200-ish employees.
Yep.
How would you describe Vouch's culture, and how do you maintain that culture?
Yeah, it was one of the most important things for me from day one. Look, we've all, I think, taken things away from the other cultures we've worked at. One of the first things Sam and I did was sit down at a bench in Soma and like talked about what are the core values we want to optimize for. And we ended up deciding on things like put people first. And one of the ones I was really pushing for was like seek truth. And we ended up landing on listen, challenge, grow because, you can be a little too hard-edged about it. So like we wanted to make sure people are listening too. Point being, I think one of the things I would do differently looking back is we were looking at our early group, right? First 10, first 15 people. Everybody was the kind of person that you needed to tell to take more vacation. Like, these are really hardworking, ambitious people, and we built a culture to recognize that. As you grow, and look, you had everything going on in 2020 and 2021, I think for Sam and I both, we are default, like, empathetic people that care a lot. And I think as a result, that allowed me to, like, gloss over certain things in our culture.
Interesting.
And so I've been really intentionally trying to make sure that like high expectations and accountability and all those things persist as we grow. And so I think that all starts with the values you emphasize, the expectations you set with people, how you reward the people that really exceed those expectations and recognize them. And I think just holding a really high bar. Every episode I think I've heard you had people on have talked about like, don't hire when hungry, right? Like, don't lower your bar. That's been every key mistake I've made, and I think like we had talked to the team today. If it's not a hell yes, it's a no, and I think you gotta really maintain that.
Yep. What's your favorite interview question?
Oh, okay. It's changed a couple times over the years. Tell me about the best team you've ever been a part of, and I don't care whether it's sports, school, whatever. More recently, I've actually started asking more about, tell me about the hardest thing you've ever been through and what did you learn from it? Nice. I think that that resilience is one of the most important factors.
Nice. Very cool.
What's your favorite?
Oh man. I ask, what are you most proud of in your career so far? And it always has a very interesting story. And it's not directly the thing they're proud of, but it's why they say that and what they call out. Yeah. And I find it just reveals so much about like what you value in your character.
Are you a fan of the like How to Hire book?
100%.
Yeah, yep. I think that discipline of like asking the right questions and really digging in on people's backgrounds, I would recommend that book to anybody.
Yeah, we completely could not agree more. Process called top grading, detailed in this book, by far the most valuable hiring approach we've used. Yeah. Awesome. All right. What do you have for entrepreneurs just starting out today?
It's funny. My gut reaction on that is to just do it because you learn so much. I remember like each job in my career, I was like, oh, my growth curve is going. And then it's like, oh no, this is a whole new thing. And like, it's worth it no matter what. That said, like, I think being really I'm very fortunate that this feels like, again, my life's calling, and that I think if you can find that thing you're really passionate about, it helps you get through the hard times. But also, like, I think feel pretty solid about who you are. Like, it's kind of like marriage and dating in that if you go in there an unformed person, that's not fair to your team. And I think you got to make sure that you're at that point in life where like, you've got yourself sorted so that you can go be the leader that other people need. Makes a ton of sense.
We were talking about this a little bit beforehand. How do you balance work and family, and sort of tell folks about what's your routine?
I remember before I started Vouch, there was someone I really, really deeply respect that was like, look, Travis, I tell everyone on my team, it's work and family. Nothing else matters. And that has just like lived in the back of my head ever since. I've had to sacrifice a lot of my like close, haven't like burnt those bridges. I just don't see these people as much anymore.
Yep.
And my family's really important to me. Obviously, talked about the influence my parents have had. My two brothers, we're still very close. My youngest brother's office is like around the corner.
Nice.
But my wife Elena and my son Theo are like the most important things. And so I think I would be nothing without the influence Elena's had on me. And I think Theo has just you think having kids is like going to be this extra thing. And oh my gosh, how am I going to do all this? And I got this other baby that's like 5 years old, Vouch, that's like chaos.
Right.
It has made, I think, being a founder that much better. And having something that I can pour all of my energy into outside of work, couldn't ask for anything more. So I'm personally really interested in learning from the other people that are trying to build really ambitious companies and families at the same time. So if you don't mind, like I'm curious, what advice would you have for me?
I'm new to this as well. We have kids roughly the same age, both very young. And it's definitely a balance. I view it as sort of a continuum. You just have to, as a founder, you have to always be at least semi-available because who knows what is going on. And so to me, it's just trying to get work done when I can, spend time with kids when I can, spend time with my wife when I can. It's a complete circle. I don't know.
Yeah, that's pretty much right.
Yeah. Awesome. I have one more question, then we're going to open it up to the audience. So start thinking about your questions here, which is you've sat on the investing side, you've sat on the founder side. What traits do you think are really important as a founder? What makes for a great founder?
I think it's that tenacity. Great. I mean, look, this feels a little cliche, but the whole growth mindset thing, like actually learning from your mistakes and getting up and facing that next challenge head on. This is kind of cheesy, but like there's this Theodore Roosevelt quote about a strenuous life being the one best lived. And that's like part of why I named my son Theo. And I think just choosing to tackle that next challenge. I mean, like we are here today because of the other individuals and groups of people that came before us that chose to go build things and take on hard challenges.
Yep.
And so like I think you can either choose to view that as an entitlement to take advantage of or an obligation to go build the next thing. So I think just like having that attitude is really important. But actually when you were first talking about it, I think curiosity is the one overlap between the two. That you need to be really curious to be both a good investor and entrepreneur.
I think that's totally true. I think it's also, unfortunately, startups have been so romanticized in the popular culture. It's like, oh, everyone wants to start a company. You are signing up for this obligation where like this becomes your life's work. And I think what a lot of founders don't fully appreciate is your team, yes, is excited as joined a startup, but they didn't make that same choice, right? They have done it as a job, they want to build something, but you as the founder, like you made this conscious decision to start this company. And for better or worse, like it's a complete roller coaster every single day. And so you have to have the tenacity, the curiosity, the obsession of whatever you're working on, or there's no way you should run the company because it won't make sense.
Totally. And you got to figure out, it took me a couple years to figure out like, what is the thing that allows me to switch that off and like go to sleep at night?
Right. That is the perfect ending. All right, what can we answer from the audience?
With AI being integrated into more products, where do you see E&O and like IP policies and any new products coming for essentially supporting AI products?
Yeah, so I couldn't have asked for a better question. Vouch, about 9 months ago, launched the first policy specifically to address these risks because there's actually a lot of gray area in other policies out there on E&O and IP and cyber about whether or not, so there was a survey of the top 12 E&O carriers, and 8 of them were basically like, yeah, we'll see if we pay those claims when they come in. And then the rest were like, no, we're not. And so we came out and affirmatively said, yes, these risks are covered, which we're the first ones to do that. A couple other folks have followed in smaller ways since. And I think that's actually really important because here's what happens. And it sounds like you've probably experienced something like this. We see this most often when you're selling to a regulated category. So let's say you go sell to a healthcare system. The compliance department is going to say, well, who's on the hook when this thing inevitably hallucinates, something goes wrong, et cetera. And we were talking to a bunch of founders that said, like, our deals keep getting stuck at this stage because we don't have a good answer. And we don't have the balance sheet to just pony up and say, yes, we'll do it. And so this like proof of AI insurance thing, it allows them to say, hey, we have coverage for at least up to this amount. Now, to be clear, there's a price for it because we have to price in the risk that is today relative to other more known risks, a little uncertain. But it at least allows you the choice to go like get those deals done and unblock it. So that's a big part of it. I do think a lot of the IP stuff is very up in the air right now with different court. Like ultimately, the courts are going to decide the legal stance on that. And then the last thing is just you didn't ask this, but from a cyber perspective, we were saying cyber attacks go through the roof right now because as you can imagine, like social engineering and all that stuff gets a lot easier. And so that is especially, we are seeing actually like VCs move a lot of money around. They haven't historically cared about cyber insurance. They need to. Stuff like that. Cool. I don't typically get like the insurance questions.
Yeah, I know.
So
this is
great. Yeah.
Yep, here. Oh.
I'm curious, maybe even for both of you, since you're in, I would think accounting and insurance. When you think of TAM and how we define that, they sound like very large sectors. So do you have advice? I'm curious your approach for first-time founders, right? So that becomes one of the most important questions from an institutional investors who don't have prior exits. Do you have an approach? Because it feels like it's an art as much of a science. And then how you defend it when you're trying to, it often feels like a decision maker. And I'm curious if you have a trick or an approach that has worked in the past for you.
And you're asking like how you define your TAM, describe your TAM.
I mean, you can make anything up, but it's how you
100%.
defend it, right?
Yeah.
So I'm curious if you've done things in the past or the first time out of the box, if there was something you found that really worked for you and how we think about it.
It's a really good question, and this is top of mind for investors. I'd say in my entrepreneurship journey, it's been an increasingly like just larger market focus. So my first company was in document collaboration back in 2007, and at that time, that was a very sort of unknown sized market. Dropbox and Box had just started; it was not clear what was going to happen, and so we were really pitching around the tech and just like what capabilities this would let people tackle. My second company was developer tools, Crashlytics. That was a larger market, but still not massive. There hadn't been really any huge developer tool outcomes back in 2011 when I started that. I think the last was like Mercury, the prior Mercury in the 90s. And then obviously for this, it's like accounting is a truly massive industry. It's like 200 billion in the US alone per year. And so I think you have to tell a story that matches the product you want to build. And you definitely have to say like, okay, this is over $1 billion market. That's like the sort of minimum bar, but you're right. It's all made up from there. And so I think you try your best to give the data points you can. What I would recommend, and as you have your early stage pitches, is you also don't want to get trapped as a lack of focus. Because if you pitch this massive TAM, the investor's going to be like, okay, that's a lie. Like, right, you're only doing this little piece of it. So I like sort of slides that pitch like, hey, this is the huge industry. This is where we're starting. It's quite a small corner of it. But you can imagine, you can see the dotted line from where we start here to where we could grow into this. And I think that shows the investor that you understand the market you're approaching and you aren't crazy. You're realistic about what you can do, but you have a vision that's broader.
Yeah, I really agree with that. If you want to talk like banker speak, you call it the TAM, the SAM, and the SOM. I forget what the S stands for, but it's like S addressable market and S attainable market. And that's like really start with, I mean, Allison, I've talked about your business. I think really honing in on that, like whatever that ICP is, architects or like home designers, right? Like really focus in on that. But then it's like, okay, as you zoom out to the total TAM, that's where the art of the possible of like, yeah, we're going to sell to everybody that uses CAD or whatever, right? Mm-hmm. But here's my other real like honest feedback on that is like, you got to be really honest with yourself about what that TAM is and recognize like, hey, I don't know how much, like, you got to find the right amount of capital that's right for your business, right? And so I think just having that like thoughtful like if you have a really good answer to, well, why do you need this money and how is it going to deliver a 10x outcome for me? That's another part of it.
I had a great conversation actually with a founder the other day who had that realization, and he was planning on going out and raising a big round and so on. And then as he was doing the modeling, he stepped back and he was like, actually, like our addressable business is this size, and it might be actually time to recalibrate the strategy, because if he kept his raise small and kept his team lean, he could actually have a great outcome in a more constrained market, right? And so you want to be really intentional on how you raise.
So I think I was getting too excited as you were talking, because yes, and like look, we had to raise a bunch of money for our strategy. Like it's the nature of our business. But I get pretty excited about businesses that are like, yeah, we're gonna raise $1 million and that's all we're ever gonna need. That can be extremely rewarding.
Yes, over here. All right, so hold on, wait 1 second, sorry.
All right, so it's just a meta question. So you guys, both two founders up here, what does the world look like if you win? So, you win, you go through the long haul, 10, 20 years. What does the world look like?
Well, I want a house like Jeff's. No. No, but seriously, I actually this is so cheesy. I have a slide I use sometimes with the team. You know, the like Star Trek SF Utopia kind of meme. It's that, but with like a vouch billboard. But I like seriously, for us, it is, I think we can be a financial institution in the same way that a JP Morgan Chase or Berkshire Hathaway has been for the last 100 years. If we understand innovation risk better than anybody else. The reality is, like for me, is the question for the business or for me personally? Reality, as much as I would love to say that like, yeah, and then I'll retire early and play a bunch of golf and hang out with my kids. I took more than a few days off around the holidays for the first time. And I realized like I can only read so many books and play so much golf. Like I gotta have something to do. So who knows what that'll be, but I gotta keep busy.
I'll answer you from the perspective of Crashlytics. So we started it in 2011. Today it's on 6 billion MAU, right? It's active on effectively every phone on earth. And I've talked with a whole bunch of the sort of mobile teams, and folks believe it's one of the most executed pieces of mobile code ever written because it launches when every app launches on phones. And so what changed, right? In 2011, 10% of App Store reviews mentioned the word crash. Today, that's very rarely an issue. And so it's had that impact, and like we had a fantastic time at Twitter. Like it's so cool having built software that like is literally everywhere. But then after that 6-year journey, what do you do? Like, I love coding. There's nothing better in the world than coding. And so I start coding, and then I got super frustrated at the accounting and the finance, and I was like, okay, well, we need to go fix that. And so you're just on to the next journey. Yeah.
All right, guys. So let's talk about billboards. So both of you got a billboard up on the highway. So what was the decision like? Is it worth it? Like, what is the sort of like investment decision?
Yeah, so so you guys probably all remember like around 2018, Brex first took advantage of like, oh, billboards were super cheap, no one was doing it, so let's go exploit that. Other startups did similar stuff with like direct mail and these other kind of offline mediums. And so when we launched, I remember we bought billboards in Utah, we had billboards in the Bay Area, and then a couple of years ago, we stopped doing billboards. We stopped doing a lot of our brand advertising, but still like 2 years later, we'd get the like, how did you hear about us? A billboard. And we're like, okay, because it's really hard to measure, right? So like the attribution is really tough. And so we started doing them again recently. It was actually, I forgot to do this earlier. We are here today because of another Startup Grind event that James hosted over the summer where Jeff and I really properly got to hang out for the first time. So thank you, James. And it was there that we were talking about billboards, and I was like debating them. I'm having the debates with my finance team, And Jeff shared his experience with it that tipped me over the edge. I'm like, yes, we're going to go do this again. So I hate to say it, but like there really isn't data that is going to tell you like this is a no-brainer. You got to talk to your customers, and there's a little bit of like the anecdotal, gut instinct around it.
I could not agree more. I mean, they are impossible to measure. I think anecdotally, they're very effective from a brand marketing perspective, but it depends on your market. You need to put them where your market is, where you're going to get high traffic. The reason we started doing a billboard is I was at Box in 2009. So my first startup was acquired by Box. It was the first acquisition Box ever made. They were 40 people, brand new, entering this document online sharing space. And if you recall the history, Box predated Dropbox. So it wasn't a sort of popular category back then. And they were going up against Microsoft SharePoint, this huge behemoth. That was like what all the businesses used to share files. And Box was struggling to compete, struggling to get attention. And I need to ask Aaron where the idea came from, but they decided to get a billboard. And they put a billboard on 101 that said Box.net is like SharePoint. That's all it said. And what was fascinating is the target actually wasn't the customers because they were selling to big enterprises that weren't necessarily here. The target was the tech press. And so all the tech journalists saw that billboard, and then whenever they wrote about SharePoint, as they're like, whatever launch Microsoft did, they would have as the last paragraph, among SharePoint competitors are Box.net and blah, blah. And that is how they anchored the market. And so it was just such effective branding for them that I was like, okay, we need to do this around our sort of launch and go to market just to get name recognition. And I think that is working. So they're very effective if you're super precise with the strategy.
What do you think is the next billboard?
We have a plan. I can't say yet.
We do too. We should talk about it later.
Okay. Stay tuned. Yes.
If you were in your 20s and like went back, what would you do differently for like, I guess, someone in their 20s?
You call me old? No, I'm just.
Nah, bro, I thought you were like 30.
No. What would I do in my 20s? I wouldn't change a thing because I feel very lucky with how things have worked out. Really try to get to know yourself and like what it's going to take for you to be your best self. Surround yourself with great people that you really care about. And that includes work, like join really ambitious, great teams, and just go do hard shit. I don't know. Yeah.
I would say whatever you imagine yourself in 10 years, wherever you like want yourself to be in 10 years, spend as much time as possible doing that exact thing. Because then in 10 years, you'll have 10,000 hours of experience doing that thing and you'll be one of the best of the world at it. And so like I had always been obsessed with startups. I had a software company in high school. I have a tiny little thing, but I just like was obsessed with the idea of building and selling software. And so I just spent all my time building and trying to sell software. And like in college, ended up raising money for this first company. We had no idea what we were doing. We made every mistake in the book. We didn't even incorporate until we got a term sheet, which is a nightmare, it turns out. We filed taxes late because we didn't know when taxes were due. Like you make every mistake, but it doesn't really matter. You're learning everything as quickly as possible.
Do you think that will actually change the way you can pitch yourself to, let's say, VC? Because every time they hear us talking, they think, I've heard of that. Oh, I've seen the dead body around there. Do you think that will change, differentiate you?
Which part will change or differentiate?
The thing that you've been focusing on, one thing, or a thing that you're really fascinated about?
I think if you, again, going back to founder market fit, if you really live and breathe what you want to be doing, I think that expertise is a huge differentiator. There are definitely trends. There are definitely categories where VCs have been like, okay, we've seen that industry. There's so many failed startups there. We're not investing. It only takes one to say yes. So like, I wouldn't have let that shy you away.
Yeah, and even if it's not direct, like, insurance to insurance, it's rare that there's not some translatable like lesson to whatever the next thing is. Also, I didn't hear insurance on your list of things you didn't do to do up front.
We definitely screwed that up at the first company for sure. Now we're a happy Vouch customer.
Oh,
so.
thank you.
Yes, over here.
Yeah, Travis, earlier on, you said your customers at the end of the day are buying an insurance policy.
Yeah.
Like that is your product. So where do you see insurance innovating over the next 5 to 10 years?
Yeah, and as we talk about it, they're actually buying a promise that we are there when it matters, when they file a claim. Where do I see it innovating? So there's this rule of thumb. I'm going to talk specifically about business insurance because that's where we live all day. there's this rule of thumb that 30% of business risk is insurable. And so you think about all the risks you take on as a business, right? There's a lot that you need to just accept, avoid, mitigate. Risk transfer is insurance. At the end of the day, insurance is basically an information and capital problem. And especially as it relates to business insurance, it's really hard to get the data and get it at the right cost that allows you to appropriately insure the risk. And so I think with AI taking, frankly, some of the human cost out of the value chain, making people more efficient, and the ability to get new kinds of data from new sources. So for instance, like we integrate with your Vanta account, your Carta account, et cetera, right? That I hope that we can move that needle up to like 35%, 40% and truly innovate on new kinds of coverage that allows people to take new risks. So that, and then I think like new risk structures to take on things, we were talking about like workers' comp and dental earlier, right? Like I think there's, all those things together can also allow like capital markets innovation that allow you to go basically like facilitate the right pools of capital and take on new risk. Yeah.
Yes.
I have one more question. All right, this is for Jeff. So I'm wondering how you're coping with like basically the polar opposite of your past business. So with Crashlytics, you basically like wrote some code and it basically served itself on all these devices.
Yep.
Now you're like in accounting where every client is a pain and they're all snowflakes that need a whole bunch of hand-holding. So how are you dealing with that?
That's a great question. It's so funny because on the surface they seem so different, and actually from a technical perspective they're so similar. And so like for Crashlytics we were classifying crashes. At Digits, we are classifying transactions, and the technical approach is actually remarkably similar, and some of our architecture inspiration was directly from it. A huge bulk of our engineering team is the original Crashlytics team. And so I really love the like just deep problem solving and the complexity. And as you all know, our accounting is incredibly arcane. There's so many edge cases. And so yes, every business is unique, but in the same way, every crash was unique. There's approaches you can take to really make a ton of meaning from the data.
Can I actually ask him a question real quick? So you and I were talking about like work styles earlier, right? We have the office thing going. You guys are fully remote.
Yes.
I gotta laugh. We're sitting here in a canopy. That was like the first office we paid for, not working from like a free office. Why did you go fully remote? What about your prior experiences like led you there?
Yeah, so we started Digits fully remote in 2018, so this is way pre-COVID, and this was directly influenced by my experience at Twitter. So both my prior companies had been in person, in one office, that was all great. And then at Twitter, I was named head of product in 2015, and suddenly I had teams in 11 offices around the world, 450 people, and it was just utter chaos because some of the offices were infighting, like Boston and New York didn't like each other, and like they wanted me to fly there and visit them. They felt the need to fly to SF to be seen at headquarters, and there was just so much drama and overhead from how you were actually like operating the business that didn't deliver any customer value, right? Like the customers never saw that or cared. And that was part of the reason Twitter moved slowly and had other well-known challenges. And so when we were starting Digits, my co-founder and I looked at each other and we were like, either we are going to do this in one office under one roof all together, or there can be no roofs, because we didn't want to have these sort of second-class citizen effect of folks in other offices. And we decided like there was no real way we thought we could build the company we wanted to and find all the talent we needed in San Francisco. And so the moment we rejected that as an option, the only choice was no offices. And so it's been great. Like we've been fully remote since then. You have to be extraordinarily intentional about how you do it. And I think a lot of founders just sort of tiptoe into a mix and they're like, oh, I have someone here and I've found another person to hire here, and they don't have a plan of how they're going to actually operate the business. You have to be really, really disciplined. And so just a couple of the quick things we did. We only hire in continental US time zones because time zone is one of the biggest challenges. We all effectively work US Central Time because we want everyone online all at the same time. We do as much as possible as sort of a buddy system, so I have 2 people working on every project, particularly in engineering. We do a ton of pair programming. And you would think you get less done. It's wrong. You actually get more done because you're self-accountable to each other and you're just constantly collaborating and the quality output is way higher. And I've run an all hands every 48 hours for the past 6 years because we do a Monday, Wednesday, Friday check-in meeting with the whole team. And so it's like that tight-knit communication really makes it work and completely makes up for what you'd miss in a traditional office setting.
How many people do you guys have right now?
65.
Yeah. Do you think you'll always do the all hands 3 times a week, or might
Yep,
that? Yeah,
for sure.
Yeah.
Yeah. And I do open Q&A at the end. Anyone can ask any question. We run the whole company on a weekly sprint. So it's every Monday we share the goals for the week with the whole company. So again, you just have to be like really intentional about it.
Yeah. I love it.
Great question.
Yeah, it surprises me the amount of time and energy you need to spend on the basic stuff like that, right? Like, I think a lot of people get into startups and they're like, oh, I can't wait to do all the shiny object stuff. Like,
Right.
No, it's like how you run your meetings and how you set your goals. That stuff really matters.
Yes. And that's where it goes back to, like, when you're choosing to start a company, and you said you sat down and had the sort of vision and values talk right at the start. It's like, what are your values? What matters to the culture? How are you going to hire people? How are you going to actually run the team? How are you going to run the work? You're making all of these decisions that aren't directly the product. It's how are we going to operate as a business? And then you also need to focus on the product.
Totally. 1000%. Go ahead.
I'm glad you went back to values. People talk a lot about values, something you hang on a wall somewhere, you don't have walls, great. I think the real values that a company have is like what people whisper to the new hires on their first day on the job. But what would you fire your best engineer, your best salesperson for? Because I think that's really your values, aside from criminal activities.
Yeah.
Okay.
Oh, of course. Oh, I mean, I have a great answer for this. So this is back in Crashlytics, but we were in Boston in 2011 building this business, mobile, right? We needed mobile engineers. And so we were desperate to hire. We had this one candidate come in who still to this day, I think was probably arguably the best Android engineer in Boston at that time. And in the interview, my co-founder happened to ask him, so like, picture yourself getting angry in the office, what happens? And he was very candid, and he said, oh man, if someone does something, I'll get pissed off. I'll probably like stand up, look around, stomp around a bit, and like walk out. And we're like, what? It's like, I appreciate the candor, but like, we can't hire you. And we did not hire him. And right, you have to be really disciplined about what you value. And so what we still do today at Digits is we look for very experienced talent, but who are also chill. And and that's actually a hard combo to find. And as a result, I can't recall having an argument across the team because the only thing that matters is like, what is best for the customer? Let's put the options on the table. Let's evaluate them and pick one. And if we pick wrong, we'll do the next one next week. Like, it's like, let's just be productive and constructive. And so that's one of the core things.
Yeah. This is a good question because I've had to do this. And I talked earlier a little bit about like you can be too empathetic, and I want to clarify a little bit of that. Like, you have Kim Scott's radical candor framework, right? And you can pick at that a little bit, but you have to both care, let them know you care personally, so that you can challenge them directly when you need to. And she calls having too much empathy ruinous empathy, right? And I think when you ask like, what is the thing you'd fire somebody for? You'd have to make a pretty egregious mistake for me to fire you on your first mistake. To your point, like, blatant ethics violations, criminal activity, right? To me, it's the second and third time. And that's where I think you keep wanting to give people a chance, but ultimately like that, it drags down everybody else. So that's my answer.
Let's do one or two last questions. Yes, right here.
Going back to the founder fit, I wanted to ask you, I'm sure that when you were starting your company, you had a lot of ideas and probably you had more than two that you were like a fit. So how did you end up deciding on the one? Was it more like experience or more curiosity? Like, how would you choose between those?
Yeah, great question. After I left Twitter, I did a similar thing. I took time off and then it was like, can't think of anything, totally burned out. And then it got to the point where I was like, I miss coding. And then I'm like, okay, let's go back and do something. But so my co-founder and I were in that exact spot of like, okay, we want to build something again. What do we build? And this was 2017. And I had seen a lot of friends of mine who had sort of done their first thing and were on to a second thing, I think make the mistake of just picking something too quickly. And they sort of threw 300 ideas at a whiteboard, picked one, and were off and running. And then it was a huge struggle. It didn't turn out well. And so we wanted to try to be more thoughtful. And so the process we used is we decided, okay, we would shortlist 3 sort of industries, 3 verticals, and spend a month in each. And then we could go deep enough to just get a real sense of like what was in it. And we just tried to meet as many people as we could and like actually code and build something small and just like understand the space. And so because this was 2017, we picked crypto, we picked IoT, and then we picked B2B software, sort of finance software. And that had been an idea of ours. As something, because at Twitter I'd seen just the vast difference in quality between sort of engineering dashboards and the finance dashboards, and I was like, clearly something could be better here. And so crypto, I wrote a Bitcoin blockchain parser in straight C, decided that tech wasn't that interesting to me. IoT, my co-founder literally bought 200 smart home devices and outfitted his entire place, and it was just chaos. And we were like, okay, I don't know, like really what we would do here. And then we prototyped sort of some better accounting stuff, and we were like, okay, that's interesting, and it's a large market, and it's software, and it was unsexy, and there wasn't a lot of activity in it. Like maybe this is an opportunity for us. So I think my advice would be just like be disciplined again, like do the work. Don't just like sort of pick an idea randomly.
Yeah, totally. I apparently my family is like glutton for punishment. Like I've worked in government, banking, insurance. My brother runs a mortgage startup, like big regulated, awful to work in, and the lowest NPS industries possible. But I actually think it's like the low NPS thing that like gets me excited because look, we still to this day have actually very little competition because it's like a hard problem to go solve. So to answer your question more directly, I remember when I first started like talking to people about the Vouch idea, I also had this other idea in my mind. My brothers and I are also very ADHD. And so I wanted to, and this was 2016, so I wanted to build a VR therapeutic for ADHD. What that meant, couldn't tell you, but seemed cool. But this, like I said, this was very clearly stars aligned. It was kind of my life's calling, so there wasn't really another path.
All right, let's do one last question.
My name is May from a startup company, May. We are developing autonomous smart home. And because the future that I see is sometimes I feel like very far, but I know it's happening. So my question is, when you see your vision or future, and you know that it's happening, but sometimes you feel it's very far and it's hard to, sometimes it's hard to believe yourself. And I wanted to ask you how you handle that situation. Or is there any advice for that?
Two things come to mind. I mean, one, obviously, as the founder, you need just extreme conviction on what you believe this future is going to be. But you also need a way to bridge to the present because otherwise you won't be able to fund the business until that future happens, right? And so I think the classic story here is Netflix. Reed Hastings saw this vision of having movies over the internet, and of course it wasn't possible when he started the company, which is why they spent years shipping DVDs. And that was not the business he wanted to be running. It's a huge logistical operation, et cetera, but he came up with a business that bridged to his vision for the world. And I think during that time, obviously, they gained so much experience and talent and customer base and so on that then it allowed them to very quickly realize their vision once the technology existed. So my advice would be to think about it in that lines. Like, what can you bridge to the future?
That was such a good answer. Could not agree more. Like, all those futuristic insurance products I want to go build, you got to go do the core stuff first today. My other honest answer to that is, like, for me, it is a good shoulder to cry on when you need it, and like heavy weights to go lift or whatever your thing is to get a little anger out when you need to.
Amazing. Well, Travis, thank you. This has been awesome.
Thanks, Jeff. It's great.
And thank you all for joining us. Huge thank you again to Startup Grind, Canopy, Wente Vineyards. Really appreciate it.
Please like and subscribe to our YouTube channel at Digits Financial and follow us on your favorite podcast platform at Between Two Founders.